Hey guys, welcome back to the channel. So, we've been talking about real estate and we're going to keep on this, right? Because one of the things, we've talked about is like buy and hold real estate and then, flipping real estate. But those aren't the only ways, right? There's a couple different ways. And I want to go over 5 different ways to invest in real estate, right? Because buying and owning real estate is going to be an investment strategy that can be both satisfying and very lucrative, right? Unlike stock and bond investors, prospective real estate owners can use leverage to buy a property by paying a portion of the total cost up front and then paying off the balance plus interest over time, right? A mortgage. Well, while a traditional mortgage generally requires a 20% to 25% down payment, in some cases, a 5% down payment is all it takes to purchase an entire property. This ability to control the asset the moment papers are signed emboldens both real estate flippers and landlords, who can, in turn, take out second mortgages on their homes in order to make down payments on additional properties, right? So I want to get into, the 5 different things, 5 different ways to invest in real estate, some pros and cons of each, right? And hopefully be able to give you some information on maybe which way you would like to do it, right? The first one we want to get into, though, is going to be rental properties, right? It's one of the big ones. So owning rental properties can be great for individuals with a DIY, a do-it-yourself, and renovation skills, right? You got to have the patience to manage tenants. However, this strategy does require a good bit of capital to finance, and then there's upfront maintenance costs, and you got to cover vacant months and stuff like that, right? Well, let's talk about some of the pros and cons. Well, some of the pros: it provides regular income and properties can appreciate, right? It maximizes capital through leverage, right? And there are many tax deductible, expenses associated with it, right? Okay, well, what about the cons? What can be tedious managing tenants, right? Potentially, damage property from tenants, and then reduce income from potential vacancies, right? According to the U.S. Census Bureau data, sales prices of new homes, right? So it's just a rough indicator for real estate values, consistently increased in value from, the early 1940s to about 2006, right? It dipped a little bit right before the financial crisis, right? In 2007 and 8. Subsequently after that, right, sales prices resumed their ascent, right? Even going way above the, pre-crisis levels during the 2008 and all that, right? But it remains to be seen the long-term effects of the coronavirus that we're currently going through, like what it's going to have on real estate values, right? I know currently here in November of 2021, we're seeing some of the prices of real estate at all-time highs, right? And we don't know if it's going to keep going up or if it's going to crash, right? You keep seeing new stuff about that every day. The second thing I want to talk about is going to be real estate investment groups, right? Because they're ideal for people who want to own real estate without the hassles of running it. Investing in, these investment groups requires a capital cushion and access to financing. These groups are like small mutual funds that invest in rental properties. In a typical real estate investment group, a company buys or builds a set of apartment blocks or condos, then allows investors to purchase them through the company, thereby joining the group. A single investor can own one or multiple units of self contained living space, but the company operating the investment group collectively manages all the units, handling maintenance, advertising vacancies, and interviewing tenants. In exchange for conducting these management tasks, the company takes a percentage of the monthly rent. A standard real estate investment group lease is in the investor's name, and all the units, pool a portion of the rent to guard against occasional vacancies. To this end, you'll receive some income even if your unit is empty. As long as the vacancy rate for the pooled units doesn't spike too high, there should be enough to cover costs. Okay, well, what about the pros and cons? Well, pros are more hands off than owning rentals and provides income and appreciation. Well, the cons are the vacancy risks, similar fees as mutual funds, and it's going to be susceptible to not very good managers, right? Let's move on to number 3, another one of the really big ones: house flipping, right? It's huge these days. Because house flipping is for people with significant experience in real estate valuation, marketing, and renovation, right? House flipping requires capital and the ability to do or oversee repairs as needed, right? This is the proverbial wild side of real estate investing, right? Just as day trading is different from buy and hold investors, real estate flippers are distinct from buy and rent landlords. Case in point, real estate flippers often look to profitability sell the undervalued properties they buy in less than 6 months. Pure property flippers don't not often they don't invest in improving properties. Therefore, the investment must already have the intrinsic value needed to turn a profit without any alterations, or they'll eliminate the property from contention. Flippers who are unable to swiftly unload a property may find themselves in trouble because they typically don't keep enough uncommitted cash on hand to pay the mortgage on a property over the long term. And of course, this can lead to continued snowballing losses, right? There's another kind of flipper who makes money by buying reasonably priced properties and adding value by renovating them. This can be a longer term investment where investors can only afford to take on one or two properties at a time. What about the pros and cons? All right. Well, some of the pros are it ties up capital for a shorter time period, and it can offer quick returns. What about the cons? Requires a deeper market knowledge. You really got to know what you're doing. You really got to know your market. And then hot markets cooling unexpectedly, right? You're selling, 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 and then all of a sudden no one's buying. The fourth thing we want to talk about is REITs, real estate investment trusts, right? These are going to be best for investors who want portfolio exposure to real estate without a traditional real estate transaction, right? A REIT is created when a corporation or a trust uses investors' money to purchase and operate income properties. REITs are bought and sold on the major exchanges like any other stock. A corporation must pay 90% of its taxable profits in the form of dividends in order to maintain its REIT status. By doing this, REITs avoid paying corporate income tax, whereas a regular company would be taxed on its profits and then have to decide whether or not to distribute its after tax profits as dividends. Like regular dividend paying stocks, REITs are a solid investment for stock market investors who desire regular income. In comparison to the aforementioned type of real estate investments, REITs afford investors entry into non residential investments, such as malls or office buildings, that are generally not feasible for individual investors to purchase, directly. More important, though, REITs are highly liquid because they are exchange traded. In other words, you don't need a realtor and a title transfer to help you cash out your investment. So in practice, REITs are a more formalized version of a real estate investment group, right? And then, when you're looking at REITs, investors should distinguish between equity REITs that own buildings and mortgage REITs that provide financing for real estate and dabble in mortgage-backed securities, right, or MBSs. Both offer exposure to real estate, but the nature of the exposure is different. An equity REIT is more traditional in that it represents ownership in real estate, whereas the mortgage REITs focus on the income from mortgage financing of real estate. Well, let's talk about the pros and cons. So, the pros, essentially, it's a dividend paying stock, right? That's really good. And then core holdings tend to be long term, cash producing leases, right? Both really good. What about the cons? Well, leverage associated with traditional real estate, it doesn't apply, right? It's just unfortunate. Okay, this is going to lead us to our last one, number 5. Online real estate platforms. Real estate investing platforms are for those who want to join others in investing in a bigger commercial or residential deal. The investment is done via online real estate platforms, also known as real estate crowdfunding. It still requires investing capital, although less than what's required to purchase properties outright. Online platforms connect investors who are looking to finance projects with real estate developers. In some cases, you can diversify your investments with not a lot of money, right? Let's talk about the pros and cons of this. Well, some of the pros are you can invest in single projects or portfolio projects, right? And then, of course, there's going to be geographic diversification, right? They invest in different parts of a country or maybe even different countries, right? What about the cons? Well, it's going to tend to be illiquid with lockup periods, right? And then, unfortunately, since there's someone managing it, you're going to have management fees, right? Okay. Well, this wraps up the 5. So what's the bottom line here? What do we get from this? Well, whether real estate investors use their properties to generate rental income or bide their time until the perfect selling opportunity arises, it's possible to build out a robust investment program by paying a relatively small part of a property's total value up front. And as with any investment, there is profit and potential within real estate, whether the overall market is up or down. So, like I said, personally, I'm getting started. I've already invested in REITs, not the mortgage REITs, right? Um, but here soon, I'm going to be getting into me actually owning property and renting it out myself. I've currently been looking. Me and my partner have been looking, and we found a couple places that we might be buying into. And of course, if I do, I'll update you guys with that information. When I do it, how much it is, and everything like that. I really hope you guys enjoyed the video. If you did, go ahead and like the video. If you're not subscribed to the channel, I'd really appreciate you subscribing to the channel. Until I see you guys in the next video, y'all be safe.